The next statement is a statement of cash flows. These are cash generated or used from three activities: operating, investing, and financing. And it covers a period of time, like the income statement, typically a year. And the insights we want: operating. How much cash did the company generate from running the business? In a startup, it could be negative because as we're growing the business, we may be generating loss, or we may generate very low profits, and we have to constantly grow our inventories and our receivables as we're growing the business. So operating activities will lead to a number, and that is the cash generated or provided by operating activities. Second is investing. This is how much are we setting aside and buying in assets for the future. It could be securities, like they park money in marketable securities a lot. It could be physical assets, like property, plant, and equipment, or it could be other types of intangible things, like buying another company and its goodwill, or buying some rights under patents, right? So there are different things that all have this shared characteristic of investments. And here again, did we use money or did we generate money from investments? Most companies, certainly Apple, we're always spending money. We're growing the business. And financing, third activity, is did we borrow or have transactions on the equity side of the business in financing the business? And in debt, it's borrowing or repayments. In equity, it's issuing stock or buying back stock. And it's also other things like dividends or other types of disbursements, like stock option plans, things like that. All right. So we see that cash flow has three activities: operating, investing, and financing. Each gives you a different angle on what's happening with the cash in a company. Statement of cash flow for Apple looks like this. We're going to start with the operating activities, and we start with net income on the very top. And then we end up all the way down to the bottom of the cash generated or used from operating activities. We see that they generated $94 billion in income. And then after we make the various adjustments to get it to cash generation, that actually ended up adding more cash. So they generated $104 billion in cash from running Apple. We would all like to have that much cash flow, right? Then we look at the next sections. Well, what about investing? We see that they are buying and selling marketable securities, which generally offset. So net is about $3 billion. But they made big investments in property, plant, and equipment, $11 billion, building out new facilities. My nephew works there, and he's part of this group that's building out assets, and he can't tell me what they're working on. So they're doing a lot of things that are into the future products and services for Apple. Then the third section, financing section. What do they do in borrowings and stock? Well, we see the biggest item is they're repurchasing their own stock. We'll talk more about that when we get into the coursework, but companies with a lot of money often will buy back their own stock to prop up and increase the value of each share, and also be able to distribute money to and gains to their shareholders, right? So that's the biggest single item. They used $85 billion to do stock repurchase. And they paid some dividends, $14 billion, right? But by far the biggest use this year of cash was for stock repurchase. And net of all that, from the three activities, they ended up with net cash flow of a negative $3 billion. You might feel sorry for them, but remember, they have all that securities. So they have a lot of cash lying around. And if they're ever short on cash, they can simply cash in some of those marketable securities and have all the cash they need. At the end of the year, they had $35 billion in cash and cash equivalents at the end of the year. A little bit more than yours and my checking account. So investing in the future, financing with debt and stock transactions, and overall change in cash. And I put less important, not that it's not important to have cash flow, but in terms of what do we learn from the statement? What we learn from the statement is the activities, the three activities. So I don't look to the bottom line on this particular statement. I find much more interesting the subtotals of operating, investing, and financing. All right, the next statement is statement of shareholders' equity, which is idea of we had a beginning balance, and then we had changes in contributed capital and retained earnings, and that's what we're going to look at for a given year. Same thing as we said earlier, it covers the period of time of 1 year. The insights we want to look at is, are they buying back shares like we just saw with Apple, Or are they selling shares to raise more money? And how much income did they earn? Again, we've seen this in the income statement, but it shows here and gives you context of how much they made compared to their equity amounts, and it shows dividends, right? So think of it as the owner's accounts and what they would be interested in seeing. In the case of Apple, summarize them into these broad categories. In the common stock area, in this case, they started with about $50 billion worth of common stock, which is the price paid by investors to Apple. It's not the market value of their stock. It's what was paid to Apple, cost again, basis. And then they issued some stock, and then they withheld some for some settlements they were working on. And then they had share-based compensation for their employees. So they issued some additional shares to employees. In retained earnings, they had cash dividends paid, they had profit from the company, and they have, again, the settlement that they're providing for. And AOCI, accumulated other comprehensive income, outside of the scope of what we're going to talk about. And as you can see, it's a relatively small item in the case of Apple, and it's a bit technical. So we'll cover this when we actually in the class where we go through in more detail. So the main items we see are sold new shares, they had net income in the income statement, and they paid out cash dividends. All right. Is that it? No, there are other components. Well, what else is there? Well, there's a letter from the auditors which evaluates the quality of the reporting and internal controls, and they state their opinion. We'll see this in a moment. Then there's a certification from management that confirms that the responsibility for the management of financial matters, the reporting and controls, lies in the hands of management. So we don't put it on the shoulders of auditors. The company is supposed to run its business well. The auditors are there to check that they are doing so, right? So that's the relationship. And next is a whole bunch of pages, could be hundreds of pages. And these are notes of the financial statements, which accompany the statements and give additional detail of what's not provided in those highly summarized numbers on the four statements. And so these four statements, plus other components, comprise the full set of audits for the company. In the case of Apple, we see it's a multi-page opinion letter. And on the very top, you see opinion on financial statements. The key phrase is highlighted here, where it says that in our opinion, the financial statements present fairly in all material respects the financial position of Apple and its results of operations, cash flow for each of the 3 years presented in conformity with GAAP. So there's a lot of verbiage there. It's kind of standard verbiage, but the key phrase is presents fairly. There's other things in the opinion letter, of course, but that's the main thing. If it doesn't say that, or if there's what we call an adverse opinion or qualified opinion, you definitely want to know what's going on, because typically there's no dispute between the auditor and the client. The second is the certification. This one is by the CEO, Tim Cook, confirming that it is the responsibility of management to look at the disclosures and that all the material facts are provided, that the report is, again, presented fairly. This is their opinion as management. And furthermore, that they have internal controls to run the company in a responsible manner. And we do this because we've seen some companies not run in a responsible manner. This whole area, this whole disclosure, this letter, comes from the Enron days when Enron behaved really badly, causing a loss of trust in the entire public trading system we have in the U.S. And so Congress and the profession had to go through and do other things to verify and to demonstrate that companies can be trusted for the information they provide. Okay, so that's what gave rise to this particular statement. The statement didn't exist before the early 2000s. Then the notes. As mentioned, there are tens or hundreds of pages of notes. Here I just picked one to illustrate an example that is interesting, right? So we have total sales, and that would tie to the income statement we saw previously, but it breaks out the sales between the iPhone, the Mac, and the iPads, and other products like the wearables, and their services. And this is something we would see in the notes because it's too detailed to be in the front of the statement. And the notes cover all types of things. Some are very technical, some are about business segments, but there's a lot of good stuff in there. I know you say, damn, I wish it was things I don't have to read, but no, there are things in those notes that you'll find important and or interesting. So in summary, the basics of financial reporting, companies are required to provide this to regulators and to other interested parties. The two standards we see in the world are generally IFRS and the US GAAP. And there are other countries that have not adopted IFRS that are large countries, Japan, India, notably. And then we have 4 basic financial statements: balance sheet, income statement, statement of cash flow, and shareholders' equity. Some of you may say, wait a minute, I thought there were 5. I'll just mention this now. The 5th one that you may have heard of is a statement of comprehensive income. To me, that's just an addition to the income statement. So we do the income statement to get to net income. Then there's a section below that covers other comprehensive income, OCI, and then getting to comprehensive income. So I don't consider that wholly a separate statement. I personally compare it as an add-on, an elaboration of the income statement. So that's why I always think of 4. It's not wrong if you think of it as 5, right? It's just a matter of interpretation. All right. And there are other components that are important, such as the notes, the letter from the auditors, the management's affirmation of their responsibility, and that generally overall financial statements provide shareholders, regulators, and any member of the general public to obtain valuable business information in order to analyze and understand publicly traded companies, each from their own vantage point.